Typically, people are overly concentrated in property or in cash. So they're not diversified enough. A lot of people are property investors who I work with. So they have a lot of property, but that doesn't mean they're necessarily diversified. Or they might have too much cash, not knowing how to deploy it properly. They might also be looking for more passive ways to grow their capital and their income. They might not be sure how to start that process. They might not be sure if they're doing it right. They're sometimes wondering, do you need an advisor? And a lot of the time I say to people, look, it's a very simple process. By all means, speak to an IFA or an advisor, but they're going to charge you. The charges are quite high. And most of the time, you don't need an advisor to manage your funds for you, particularly when you're in this sort of accumulation phase. You might find that you're looking to supplement your income. You might have property cash flow coming in. You might be looking at more diversified ways of growing your income and finding additional streams of recurring income. Money moves from those who do not manage it to those who do. This applies to all sorts of things, not just about giving your money to someone to manage, but also other things, trading rather than investing, or leaving all your money in cash. Who's the winner there? The bank is. The bank is getting cheap credit from you if you're leaving too much money in the bank. So there are so many different ways we can apply this quote, and I'm going to keep bringing it up over and over again today. Okay, so what are we going to cover today? How your money is moving into areas you want it to be within your capital, within your family wealth, and how people find their money is moving away. So we're going to do something about that. One thing you can be doing to stop that money moving away and to make sure you compound more of that money internally within your own accounts. We'll talk about investing with ETFs and about recurring income with options. So those are the things we are going to be covering today. So who am I? I have a background in investment management. I'm a professional investor. These are the firms I was working with. This is where I cut my teeth on investment analysis, due diligence, diversification, risk management, etc. And that's where I got my CFA at JP Morgan, which is the Chartered Financial Analyst. I'm no longer working full-time in the investment management world. I retired a few years ago and I never wanted to go back. It's a really stressful environment, but also I wanted to have more control over my own time. I got to a place where I was able to do that, and I have been able to continue doing that because of some of the things that I will talk to you about today. I'm also a property investor, so I own a portfolio of buy-to-lets, HMOs, and many of you are also property investors. And then this came together to form my company, InvestLikeAPro. I was working with property investors who were looking at property-related investments. I was helping them do the due diligence. And a lot of them came to me and said, look, I want to find ways to diversify into stocks, into options. Can you help me with that? So I did. And then I found that actually that was a huge area of interest for people. And so I set up InvestLikeAPro to help people to invest better, because I've been on both sides of the fence. I know exactly what happens on this side, and I can bring the benefits of that knowledge and experience to people who haven't been on that side to help them with compounding, saving fees, and investing in the right areas without necessarily needing to pay the pros to do it. So that's me. These are my core values. Whenever I do presentations, whenever I run meetings, run classes, teach people, everything I do has to be around these 6 core values, okay? Low cost, independence. I'm not tied to anyone. I'm not trying to sell anyone's products. I'm just trying to demonstrate the best things that people can be doing without taking a cut from anyone else. This is all coming from a position of independence. Simple implementation, how you can diversify, how you can save taxes. This is all evidence-led intel. Anything I say to you is all related to evidence that I have. Professional investments experience. I managed capital at JP Morgan, CFA qualified. I'm doing this daily. So everything I teach you today, everything I'm explaining to you today, everything I teach my students is all from a position of having done this myself and doing it on a day-to-day basis. There are no secrets in the investment world. If somebody tells you there are, don't believe them, okay? Because the investment world is just too big for kind of secrets to exist, okay? So I'm doing this daily. I'll tell you everything I'm doing, okay? I tell my students everything I'm doing. Nothing is held back. It's all about investing and not trading. I'm a property investor. Why are people investing in a proper way? What is your prize? Well, for me, it's about securing financial freedom, which I did when I retired a few years ago. But I need to maintain that. And I'm doing this not just for myself, for my kids, for my future generations. I want to be able to pass on what I can and maximize what I pass on to my future generations. Okay. So imagine you get to a point, because this isn't just about money. This is about having financial freedom, your own time back, beating inflation, no tax returns, no management, and it gives you passive financial security. This is your prize. I don't want to ever stop working. So I don't want to bum around on a beach because I'd get bored of that. I want to carry on working on my own terms, geographically where I want to be. And Robert Kiyosaki, you might not agree with everything he says, but he said it pretty well. Don't work for your money, make it work for you. Now, what is real investing about? This is something people get really confused by or don't know the difference between investing and trading. Most traders end up losing money. So this is not what investing is about. Squiggly lines, stop losses, all sorts of signals you're waiting for. It just doesn't work, okay? It might work in the short term. This is what investing is about. You'll recognize that all of these companies. These are the top 50 valuable companies in the world. And I can guarantee you've been interacting or buying, or you'll be a customer or user of most of these. Apple, you probably have an Apple phone in your pocket. You're probably on a Microsoft software or computer. You probably used Visa several times today. Possibly you've used Amazon, right? It's not just tech companies. Your home or your office might be heated by gas supplied by Shell or ExxonMobil. When we are investing, we are buying real companies. We're part owners of real companies which are making a big difference to the world. They're paying you dividends. You're laying claim to the profits they are making. So just don't forget what investing is about. It's not about squiggly lines. It's about real investing in real companies. So what did those companies produce? So let's have a look at 2023 returns. This is what your portfolio should have been earning, at least 17%. These were global equities. If you were in other markets, you might have got more. If you're in the S&P index or NASDAQ, you might have got a lot more. That's not necessarily going to be the same this year, but this was the case last year. And options, which we're going to talk a lot about. This was my option strategy, 23% last year. And my best performing student was more like 60 odd percent. Okay. So there are lots of different strategies. You need to be diversified. Don't just jump into one of these and don't have recency bias. Recency bias means what has done well last year. It's not necessarily going to do well this year. So this is what companies produce. And it's not just the 1 year. This is a long-term occurrence. Global equities over the very long term have produced double-digit returns on a compounded basis year in, year out. That's how you get to passive financial freedom. Now, why don't more people get those returns? Not all of you will have got those returns. In fact, a very small minority of the general public would have got these returns. Why doesn't that happen? It's all about one thing. Most people are not set up properly. Most people invest in the way I'm about to show you. So they might buy the odd stock here or there. And this is not because they're not intelligent or they don't know what they're doing. It's because we've never been trained to be investors. We grew up in a school system that taught us to get a job working for one of the big companies. So your whole childhood life was geared up for you to be an employee serving the corporate world. And then when you got into the corporate world, you're bombarded with messages to buy this, buy that, and do this, do that. So the rest of your life is you are being told where to spend that money. At no point ever during your childhood or during your adult life are you ever told how you should be investing. And that's why people don't necessarily make those returns, because it's not in anyone's interest, in the corporate world or in the government's interest, for you to become investors. That's important to know. This is what typical investors do. They might buy shares because they've heard about shares in a newspaper or on the social media or in some article. Might buy more shares. And there's no process behind this. They might buy currencies, crypto, then see volatility and go all into cash. They build up their portfolio without any sort of process. They might buy a fund, more stocks, and some other random fund. You can see there's no balance to this. And you might recognize this. You might have a portfolio of shares because you've just heard about them, right? And they don't go well together. They just happen to be in your portfolio randomly. That's why people go wrong. Most of the time, they're sitting in cash a lot because they're trading around the news flow. That's the wrong setup. JP Morgan did a study on this to see what the typical investor earns and what the actual returns they should have been earning on a set and forget basis. And that's called the return gap. So just a quick example, if you'd invested £100,000 10 years ago, you'd have left £101,000 on the table. Over 20 years, that amounts to £380,000. And that's because you're paying away fees, you're trading, you're set up properly. It's the setup, which is the one big thing which is lacking here. Okay, so that's what I'm going to explain to you, how you can be set up so you don't leave money on the table. You're not moving money from someone who does not manage their money to somebody who does. It's our friend Dave Ramsey again. So that's what is lacking. And that's what I cover. All of my students, within 6 weeks, they know exactly the process and the steps, and they set up correctly within that 6 weeks. The way you should be setting up is by building your portfolio like a house. That's the one thing that matters. So when you're building a house, what do? You build your foundations. And when you build your foundations, that's going to make sure your house is rock solid for decades, if not centuries. So you build your foundations. That's the first thing. When you build a portfolio, exactly the same principles apply. Diversification. You invest according to your personal objectives. Pound cost averaging. Minimizing your fits, fees, inflation, and taxes. Hugely important. Selecting the right platforms. Make sure you're not paying a huge amount of money away to your pension scheme, your IFA portfolios. And then you build your core. Like in a house, you build your walls, you build your core, your windows, your doors, you build your roof. Just like in a house, you do that in your portfolio. So your core, in your core portfolio, make sure you're diversified properly. You match your risk profile to what you're investing in. You're investing in a balanced portfolio, equities, bonds, money market funds, making sure it's all low cost and earning income at the same time. So income via options, dividends, and REITs. That's your core. And the idea of having your core, these are set and forget elements. So you build this once and you never have to change all of these things. You don't have to trade around. This is set. This is the basis of the set and forget investing that I talk about a lot. Once you've built your core and your foundations, then you can start decorating. You can start having some fun. You can choose your finishing. You can add some blingy features and some flashy lighting, and the same with investing. So you then start getting into your satellites. And this isn't necessarily set and forget. Okay. So this can be chopped and changed as conditions change. And you don't even, with investing, you don't need to build your satellites. You can run with your core and foundations. A lot of people do. So with your satellites, you have individual shares, themes, crypto, maybe some REITs, some commodities. And the interesting thing is when I speak to investors, I see what they're invested in. They normally start with their satellites. And if you don't have your foundations and core, what's going to happen to your portfolio? It's not going to be rock solid. It's going to blow over and you're going to be running from one thing to another. So this is why it's critically important to build your portfolio like a house. Once you've got this set up, once you've got this right, I promise you, you will have a very successful, long-term, low-cost, set and forget portfolio. The evidence is there. I build my portfolio like this. My attendees who attend the Investment Academy have all built their portfolios like this, and they're seeing great returns. You build insulation around it. So you make sure you're insulated to make sure you keep your fees to yourself. Make sure you keep your taxes to yourself. And this is what gets you to your core set and forget portfolio. Instead, you do this, and this is the benefits. And you can see which one looks more solid. This is much more solid in terms of returns, in terms of your set and forget lifestyle. Now, How is that translated to how you actually do it? So very simple, clear, set and forget process. We run 5 steps and you are literally following step by step in a clear sequence. So let me run a few of these. I haven't got time to run all of these foundations by you this evening, but let me run a few of these by you because some of these might really be eye-opening. So take some notes, ask questions at the end. Hopefully some of these will give you those light bulb moments. So number 1, these foundations stay with you for life. It's not just for you, it's for your future generations as well. So because none of us are doing this for ourselves. We're doing it for our future selves. We're doing it for our kids. Okay. So this will be passed on to your kids. So number 1 is trading versus investing. If any of you are trading, just be aware, this is IG Index. This is a common trading platform. All of these platforms have to display a wealth warning. So IG Index, 68% of retail investors accounts lose money when they're trading. They all have to display this wealth warning. And most of the time you see this, most people are losing money. So you want to be investing, not trading. Okay. This is since 2009. This is the US market. This is every correction we've had more than 5%. Why would I invest in the stock market when you've got all these crazy things going on? You've got interest rate concerns, you've got recessions, you've got wars, you've got debt crisis, Chinese concerns, etc. So you can read them all yourself. This is everything under the sun. Okay. Inflation fears, blah, blah, blah. And you think there is no way you're going to invest in the markets when you see all these events. That's why people don't invest. But actually, that's the trading mentality. When you zoom out, when you look at what's actually happened, all of these red dots, they're just a blip. All of these news flow, all of these scare stories are a tiny blip. So I know some people do stop losses. They have a trading mentality where stop losses are part of that trading process. Imagine if you had stop losses going on at every single dip, you'd be taken out. When in fact, what you should be doing is buying. You should be pound cost averaging in. Okay. So there are 27 of those losses. Okay. Every single one of those losses were opportunities. They were opportunities for you to pound cost average in to make huge returns. The market rose by 615% during this time period. That's 16.3% annualized. Okay. So this just underlines how important it is to be investing and not trading. It's your time in the markets, not timing the markets. We'll teach you how to do pound cost averaging and what to invest in to really optimize these opportunities. Again, Dave Ramsey, our friend, money moves from those who do not manage it to those who do. Your money will move from the traders to the investors. Warren Buffett swears by taking advantage of opportunities and having your time in the markets, not timing the markets. Now, that was the first sort of key foundation. Okay. Number 2 is diversification. We all know about diversification, but how do you do it properly? I'm into property and I'm not planning to sell down my properties anytime soon, but people should be conscious of how stocks and property go really well together. So I'm not saying sell your property, make sure you are diversified alongside your property because the two asset classes go well together. Now, if you're overly concentrated in property, you run a few potential risks. There's tax and policy risks. We know the policy direction has been going against landlords. Okay. There'll be possible uncertainty about what happens to landlords. So that's just a risk you need to be conscious about. Tenants, toilets, and boilers, when you're concentrated in property, these are kind of things that we are faced with as landlords. And you have UK concentration. The UK has been a good market, but it's always a risk to be overly concentrated in one market. Whereas with stocks, they give you global exposure. They're liquid, passive, inflation proof, they're tax-free. In the right wrappers, ISAs, pensions, SIPs, SASs, they are tax-free and they're a long-term compounding machine. Okay. So that's why it pays to have some allocation to stocks, both from a financial perspective and from a hassle-free perspective. to give you that long-term prize of financial freedom. That's diversification. There's a load of other stuff I can be talking about diversification. I'm not going to today, but really the diversification element essentially gives you the same amount of returns, but lowers overall portfolio risk. So that's the high-level view on diversification. When people talk about investing, it's as important to be investing in the right things as to be controlling your leakages. And now this stuff is not glamorous, but it gives you as much a return as investing in the right things. So here I'm talking about controlling your fees, inflation, and taxes. I'm going to talk a little bit about each one, and then I'm going to teach you a trick, how you might think about using what we've just learned to let HMRC pay off your mortgage. Yeah, you can actually have HMRC paying off your mortgage for you, paying down your mortgage. And a few of my investors are doing this. We need to understand how we can control our fits. Okay, so this will be mind-boggling as well. So have a quick example. John, who attended our investment academy, and you might resonate with this because you might see yourself in this situation. He had a work pension, £240,000 in his work pension. He'd left that job a few years ago. And John thought, it's a work pension. It's never going to rip me off. It's bound to be working for my own good. He didn't realize how much he was paying into the work pension scheme in fees. And those fees were 1.5% per annum, which doesn't sound that high. But when you look at the numbers, this is what he was paying on an annual basis. He was paying £3,600 to his pension scheme. What I showed him using our process is he could reduce that down to £840 per annum by doing nothing different, investing in exactly the same way, just reducing your fees by £2,800 per annum, which he was surprised about. If we hadn't discovered this, he would have kept on paying this over and over again. And over a 10-year basis, he would have paid £72,000 instead of paying £16,000 in the new way. And again, there's nothing new about it. You're just investing with lower cost wrappers and lower cost ETFs, but investing in exactly the same things. Okay. So that's a saving of, what is that? £55,000 over a 10-year period. And people are doing this all over the country, and they don't realize how easy it is to take control into your own SIP or your SAS, save fees, and invest in exactly the same way. Okay. And I helped somebody else the other day, and I put this on Facebook. So I was working with them, and this is another way of looking at it. So over a 20-year period, her investments made £617,000, but she was only keeping £398,000 of that. So pretty incredible. You're giving away £219,000 over this time period to your provider, to your IFA, to your work pension scheme, to your whoever is managing your portfolio for you. And this is so simple for you to be able to do this yourself. It's that quote from Dave Ramsey. You want to hold on to your money. Don't fund other people's retirement. Fund your own retirement. And it's simple to do this. So that's fees. Critical that you do something about it, because that's money in your back pocket in your retirement that you can use for your children, or whatever you want to do with it. Number 2, inflation. So I'm going to tell you about the real impact of inflation on your cash. Let's say the inflation rate is 4.6%. If you hold £50,000 in the bank, the real value of that in 10 years' time is going to be 31,000. The official rate is BS. So it's a lot higher than that in reality. It's a silent killer of your cash. And the ironic thing is, when people sit around in cash, you might have a cash ISA or just bank accounts. Your limited company might have lots of cash. Just be aware. And the reason you might not be investing is because you fear a crash. The real value of that is going to decline by much more than most market crashes. So be conscious about the impact of inflation. What do you do instead? Buy real assets. Now, that's number 2. And number 3, and we're going to get onto the mortgage trick, okay, by just seeing this. So taxes are important, right? And there are many ways in which you can use the tax system in your favor. You can have HMRC paying you. And it's just free money that so few people take advantage of. It literally is free money. So in your pension, your work pension, your SIP, your SAS, you have up to £60,000 per annum as an allowance. Okay. If you're lucky enough to be maxing this out, perfect. You should max out as much as you can because it literally is free money that HMRC is giving you, right? Whether it's through your limited company or your PAYE, do as much as you can whenever you can. Another tax giveaway is an ISA. So ISAs are tax-free forever. You can invest up to £20,000 and ISAs aren't just cash ISAs. You can do stocks and shares ISAs, IF ISA. You can have a LISA. So if you're under 40, invest 4,000 and you get 1,000 top-ups. That's an immediate 25% return on your investment for just putting in 4,000. You can invest 9,000 per annum for your children. That's a junior ISA. Even if you put in 10,000 per annum from your limited company, you're saving 2,000. So you're only paying 8,000. And HMRC is topping up by 2,000. If you are an employee on a 40% tax rate, if you put in 10,000, you only need to put in 6,000. The government is giving you 4,000 for free. And that's on top of your employer contribution. If you have matched contributions, you're getting free money from the employer, you're getting free money from the government. So do that as much as you can, and then you invest that into things that appreciate over time. These are number 3, your taxes. Now, putting all of that together, I've been helping one of my investors with. This investor was on the Investment Academy. If you join, you get a mentoring session with myself on a one-to-one basis. With this investor, we were discussing how might be a smarter way to pay off his mortgage. Okay? Buy-to-let mortgage, residential mortgage, doesn't really matter. So think about this, and this might blow your mind as well, hopefully. Okay? So there's lots of eye-opening nuggets in this presentation, but this kind of might just make you think a little bit. So imagine you buy a property, 200,000. You get a mortgage, 75% mortgage, 150,000. Let's say your interest rate is 4%. So what happens? Your mortgage payments on a capital repayment basis, you're paying 9,000 per annum. And that's broken down into interest of 6,000, capital of 3,000 per annum. Now and this investor was thinking, okay, instead of doing a capital repayment mortgage, why don't I convert it into an interest-only mortgage where I'm only paying 6,000 per annum? A lot of you are already on interest-only mortgage. All my mortgages are interest-only. And I'm doing exactly what I'm about to explain. So interest-only mortgage, 6,000. So you've got 3,000 here, which you're saving. Put it into your pension. So this is through his limited company. He's making a £3,000 contribution. Instead of paying down his capital on a monthly basis, he's putting it into his pension. And it's only costing him £2,430 on a 19% tax rate. And HMRC, £570. Okay. And if you are an employee on a 40% tax rate, of that 3,000, you're only contributing £1,800. HMRC is giving you £1,200 of that. So what he decided to do was put that 3,000 into his mortgage, into his pension, 3,000 per annum into his pension. If you plug that into any compound calculator, this is what you come up with, £3,000 per annum over a 25 years period on an 8% annualized basis, which is actually quite conservative, 8% per annum. I'm saying that's the average annual return in stocks. It's been more like 8 to 12%. That will get you to £257,000 at the end of that 25-year period. Now, you pay down your 150K and you're left with a surplus of £107,000 at the end of that period. Okay. So there are other things to consider when drawing down your pension. You have to do it in a tax efficient way. You can design this in a tax efficient way to maximize your tax-free element. There might be some tax you pay at the back end, but the fact that this is accumulating tax-free inside your pension will beat any other way of paying down your mortgage. And actually, your 150,000 is paid down in about 18, 19 years time instead of 25 years time using the growth of that 8%. So that's great. And this was a bit of an eye-opener for him. Your 150,000, it's not just compounding that's paying down your mortgage, it's inflation that's paying down your mortgage. So just taking over an average inflation rate over 25 years, the real value of your 150K in 25 years' time is going to be £41,600. That's the real value of your debt. So why aren't more people doing this? It's not for everyone, because you might have a particular idea about debt. We're all conditioned to pay down our debt. From a purely logical perspective, it makes sense to not pay down your mortgage on a monthly basis, to make that surplus get invested in a tax efficient way, let it compound over time, let that and inflation pay down your mortgage. You might say to me, 8% sounds a bit punchy. It's not punchy because it's actually the lower end of the range we've seen over the last 150 years. Let's see where, if you do the same numbers to pay down your 150,000, you only need an average annual growth rate of 4.6% per annum to get you to your 151K. Now, 4.6% is pretty modest, pretty conservative. I'm earning 5.5% annualized on money market funds at the moment. Easily doable, right? So it's a great way to pay down your mortgage. Now, how about it get better? You might say, what if I lose money over that 25-year period? Actually, you look at this, the evidence over the last 150 years, over any time period longer than 15 years, stocks have never lost money. There's 100% record of stocks gaining in any 20-year time period. Plus, in the short term, you can't have any idea what stocks are doing. Over 1 day period, it's 50-50, toss of a coin. The longer you hold, and these mortgages are long-term, right? So there has never been a period of time when stocks haven't increased. Okay. So that's the evidence, but it gets better. Who here would like the idea of HMRC paying down your mortgage? That would be nice, wouldn't it? So here, let me show you exactly the same numbers, but instead of paying 3,000 into your pension, if you increased your pension to 16,000 per annum, HMRC is essentially giving you 3,000. That's your tax break. Okay. So you pay 16,000. It's only costing you 13,000. HMRC is contributing 3,000 for you. So that 3,000 is paying down on an annual basis your mortgage. Okay. And do the same numbers on the compound calculator over an 8% period. Guess what? You'll end up with 1.3 million at the end of that 25-year period. It's the power of compounding, inflation, and tax benefits. Most people find it hard to get their head around, but the numbers and historical evidence proves it. The only thing you need to do is draw down in a tax efficient way. You need to be disciplined. Don't just take your money in a suitcase to Vegas to blow it. Make sure it goes into your pension and let compounding do its stuff. Set and forget. Do what's always worked. And this is pretty mind-boggling. So if there's any questions around this, drop them in the chat box, or we'll take questions at the end. Hopefully that's been a bit of an eye-opener for you, bringing in all the foundations that we've been talking about into one example here. And it just underlines what Einstein said: compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And stock markets are an amazing vehicle to compounding. In fact, it's interesting because Warren Buffett, the world's most successful investor, but one of the advantages he's had that most of us haven't is time. He's been investing for a long time and he's worth 120 billion. And guess what? 99% of his wealth that he has today came after the age of 50. It's pretty incredible, right? And what's that down to? Yeah, investing in the stock markets, but also compounding. Compounding, it just gets you can see this green line here. It's an exponential shape, right? And that's one of the key reasons why Warren Buffett is today worth 120 billion. Okay. It's all about compounding and investing. So the key message here is do the one thing, right? Don't invest like the typical investor on the left. Make sure you're correctly set up in the steps that I will show you. There's a lot more behind this, but I'm giving you the principles by which you can be setting up a correct. It's straightforward. I'll give you all the tools, all the processes to do this. Most people who attend the Investment Academy achieve this within 6 weeks. And if they don't, they can come along to the next Investment Academy without charge. Most people are surprised by how quickly this can be done in a very easy, simple to follow process. So, platforms. So you might have questions about platforms. I'll quickly go through platforms. You need platforms to set up your foundations. You need means by which you invest. Okay, so I'll quickly go through this platform. So think about platforms as almost like your supermarket. Okay, so there are 3 fees you have to pay. If you do it properly, your total fees are minuscule. If you don't, you'll end up paying a lot of fees. Your first fee is your platform fee because you need a platform to get your investments through. So almost like a supermarket, a place where goods are sold. You can look at it as a storage place as well. So the fees for a low-cost platform are anywhere between 0.1% to 5.6%. If you go to an IFA or a high-cost provider, you're paying multiples of that. They are at the higher end of that. But the worst thing is when you're paying premium fees, you think you get better performance, but actually the highest fee providers are the worst performing managers. And they're not even IFAs. A lot of these people call themselves IFAs. They're not, because you can't have access to the whole market of different funds and ETFs. So stay at the low cost end, you're going to perform better. That's your supermarket fee. The next one is your product fee. It's called the management fee. For the lower end, it's anywhere between 0.04 to 0.5% per annum. For passive index tracking funds and ETFs. For the active premium end, you're paying anywhere up to 2% plus initial fees. Okay, so sometimes these are called management fees. Sometimes they're called TER, total expense ratios. Sometimes they're called OCF, ongoing charges, but stay at the lower end of that. And then there's the trading fee to getting in and out of individual investments. So the product fee is ongoing, annual fee. This trading fee is when you go in and go out. It could be anywhere from £3 to £15 per trade. Within platforms, there are those 3 main elements of fees. So these are the ranges. Stay on the lower end of these ranges and you won't go wrong. Okay, because you've seen the returns and these fees are inevitable, but they're next to nothing if done properly. There's also a new breed of free platforms, which are free, but they're not really. So they can be good as secondary platforms. Okay, so that's your platforms. Now, the choice of platforms is a very personal consideration. I might give you a platform which may not be good for me or somebody else. It's quite a personal thing, and we'll take you through the whole process, which is made a lot easier. So the costs are applicable to you depending on how much you invest. It depends on how frequently you might want to be trading. Depends on what you're investing in. So whether it's funds, ETFs, shares, options. Okay, so there are different platforms available for options and stocks. And for different wrappers, you might have a SAS. Okay, some platforms don't allow SAS investing. Some do. Some have a SIP. Some don't. ISAs, etc. This sounds complicated, but we break this down for you. We help you individually to make sure you've got the right platforms to suit your personal circumstances. So it's quite an easy process, but the main thing is it's personal to yourself. The next step from there, you choose your platform. Make sure you've chosen your wrappers. I'm talking about your tax wrappers, your SIPs, SASs, your ISAs, etc. Then you choose your platforms, and then you choose what you're going to invest in. I talk a lot about ETFs. Let me give you a 101 on ETFs. ETFs are exchange traded funds. Okay. And they've been around for sort of 30 odd years, and they're an amazing innovation within financing. Makes you manage your funds in a much easier fashion. The whole set and forget concept is made possible with exchange traded funds. You probably heard of Vanguard. The founder of Vanguard, John Bogle, he said it brilliantly. He said, "Don't look for the needle in the haystack, just buy the haystack." When I showed you the typical investor profile, how they set up their portfolios, they're always looking for the needle in the haystack. And you win some, you lose some. Okay. But what John Bogle said, which is great advice, just buy the haystack, which means you buy the whole market through index tracking funds and ETFs. Okay. And by the way, he's got a great book out there, John Bogle. It's the Common Sense Book of Investing. Brilliant read, really easy to read. It'll tell you everything you need to know. So it's a great book if you want to learn more about this stuff. So he said it well, and that's what ETFs are. They're the haystack. These are the biggest companies in the UK, the FTSE 100 companies. Okay, Unilever, AstraZeneca, HSBC, Diageo, BP, Shell, you know the usual names. Okay. Now, if you want to buy all 100 of them, it's not practical to buy 100 different shares. You can buy an ETF that tracks the FTSE 100. It's the FTSE 100 ETF or an index fund. Likewise, in the US, these are the biggest 500 companies. It's the S&P 500 index. So Microsoft, Apple, JP Morgan, Johnson, etc. Same with tech stocks, Apple, Amazon, Tesla, Facebook. You can buy a NASDAQ ETF. You can even take away the decision to select individual markets. You can buy a global equity ETF. So these are ETFs. You can get exposure to the world's biggest companies. You remember these, right? The best companies in the world. These companies are working for you. When you're a shareholder, they only have one objective. Their existence depends on one thing, is to maximize shareholder returns. So when you own a piece of them, the CEOs, the management of these companies are working for you and I. Just don't ever forget that, because you're buying a real piece of these companies. So that's the beauty of ETFs and funds. In summary, they're low cost, they're diversified. You can get ETFs of shares, bonds, commodities, gold, silver, etc. You name it. You can get very niche ETFs, tech ETFs. You can do balanced funds. You can do individual themes like AI, technology, high dividend ETFs. There are, you can get crypto ETFs. There are all sorts of things out there. And we cover all of these in the Investment Academy. They're an amazing innovation. So yeah, have a look at those. I'm just going to quickly go through this because I know I'm running out of time. There'll be questions. I want to do an options demonstration as well. So I'm going to go through these quickly. Your satellites, look at this as non-core. Okay, you can chop and change, but here's where the sort of interesting stuff lies. So you might be interested in commodities. You can do all of this in your satellites through ETFs and funds. You can get exposure to gold, silver, metals, oil. You can do real estate. Real estate and REITs are potentially a smarter way of investing in property. With property, you can add value. You can get leverage. It's good to have both in your portfolio. You can do crypto through ETFs and funds. Options, you can get access to all these really fascinating themes. So tech, AI, robotics, aging, the aging theme, quality, clean energy, cannabis, EV, blockchain. The possibilities are endless. Okay, so quickly move on to REITs, because I know a lot of you are property investors, and REITs are a really smart way to own property. They're liquid, they're passive, hands-free. They are tax-free. So all the income and capital growth you get from REITs in your pension, in your ISA, tax-free. You get really juicy yields, dividends with some of these. So you get anywhere between 3 to 10% per annum. And the great thing is you can buy these below market value, right? So there are anywhere between 10 to 40% discounts available when you buy REITs. The downsides of REITs, you can't add value. You can buy a property. You can make an extension. You can create rooms out of a property. You can create commercial to residential, et cetera, et cetera. You can't do that with a REIT. You don't have that control. You can't add value. So that's the potential downside. And you don't own a property. There are pros and cons. I own REITs, and I think they are a potentially good investment, especially in the non-residential investments. So this is how REITs look. You buy shares of this. The REIT owns several properties. There's different types. There's a residential, office, retail, industrial. You might not have enough money to buy an Amazon warehouse, but you can buy a REIT for 50 quid. You can buy infrastructure stuff, care homes, etc. So REITs, they get really good tax breaks, and that's why they can pay good dividends, because they don't have to pay corporation tax. and they're professionally managed as well. They have a professional management team. I talked about the discounts. These were the kind of discounts that were available on the whole group. In some REITs, we were down at sort of 60%, which means a 40% discount to the NAVs. Since then, those discounts have closed down a bit, but there are still many on a significant discount. So if there's any questions on REITs, we'll take them later. Shares and ETFs can be really good for inflation hedging, right? So equities are a great inflation hedge. Historically, you can buy infrastructure assets which have their revenues linked to RPI and CPI. Commodities are a great inflation hedge. A lot of people think gold is a good inflation hedge, but it's not. So that's the sort of common misconception. Gold is not actually a good inflation hedge. If you look at what gold, when inflation was really taking off post-COVID, so 2021, 2022, when inflation was accelerating to the upside, that's when gold should have been rocketing. But actually gold was down in 2021 and 2022. So it's not a great inflation hedge as many people think. What it does do, it's a good fear trade, okay? But there's also times when gold just does nothing. It just did nothing, right? Because it doesn't have cash flow, right? Gold doesn't pay dividends, doesn't make profits, unlike shares. So it can afford just to do nothing for long periods of time, and then it can just go to the moon, and then it can go down, but shares have to go up over time. But gold has a good insurance hedge because it's a good fear trade. If there's any fear, anything bad going on in the world, gold does quite well. If there's macro stress, the dollar's going down, and it's also linked to jewelry demand. Okay, so just be a little bit careful about gold. It's a good insurance hedge in case there's something bad going on in the world. That's gold. But overall, growth and income are complementary. I'm going to move on to options very soon. This is your core set and forget growth portfolio. This is your income portfolio. They go amazingly well together. Lots of synergies. So this on the left is your set and forget inflation beating growth for your future financial compounded security. This gives you day-to-day cash flow. Okay. And I have both portfolios running side by side. So options give me 1 to 3% per month, sometimes more. High dividend stocks give you cash flow, and REITs give you cash flow. So when you operate the two together, it's a very powerful combination. Okay. So I'm going to move on to options. I'm going to see if there's any kind of quick questions in the chat box before I do that. Let's have a look. Is this recorded? My assistant is on holiday at the moment, so I don't know if it'll be recorded on time and sent out to people on time. I'll try my best. It is being recorded. Whether it will be sent out as a recording in the next week or two, I'll let you know. Is it best to build the foundations over time to avoid risk of mistiming the market? The foundations you can build are different to the core investments. The foundations are things you need to learn about and be aware of at the outset. So these things you learn at the start. The core is the set and forget investments in ETFs and funds. You can do that through pound cost averaging. Essentially, you want to drip feed that into the market. So you're not investing it all on day one. You want to be able to pound cost average that in. So you saw that big chart where all of those events over time, if you pound cost average in, you'll be able to take advantage of all of those declines. Timing the markets, exactly that. I'm going to move on to options because a lot of people are interested in options. You saw the amazing returns some of my investors have been getting, and they're an amazing product. I'm going to do demonstrations on options. I'm going to show you the steps you need for the options. Before I get on to that, I'll explain how people have achieved this in the Investment Academy. So it's a very guided process. Okay. So we have the weekly modules. You have core investment foundations. We have the set and forget plus income element. So you create your own investment plan that suits your own risk profile. Okay. So it's all very personalized for you. And you go through this process in a step-by-step way. It's very clear. It's very guided. It's guided implementation. So you're doing things as you go along, and I'm helping you through this. There is practical implementation. So you choose the right platforms. You make sure you're opening the right platform accounts. Okay. We move on to core ETFs and funds, low cost investing. You get all the short lists of the cheapest and the most effective ETFs and funds out there. Okay. So that's all given to you in a menu choice. And then you choose from those which ones apply to you and your personal objectives and your risk profile. We have a module on satellite, so REITs, dividend stocks, how to select the best ones, how to avoid the ones that are not very good, commodity ETFs, thematic ETFs. We do screening for stocks. So we help you to, if you're interested in individual stocks, for the highest dividend yielding stocks, for the ones that have the best value. This is especially good when there's been a sell-off. You can identify stocks that have been sold off the most, and you can buy things which have been bombed out, which worked amazingly well during COVID correction and any previous corrections. It's a fantastic way to bottom fish for pound cost averaging into things that have been beaten up. We have a module on secured loans due diligence, securing the right secured deals and identifying the red flags. So it's all about due diligence on third-party loans, and we have a proper process by which you can choose the loans. We have a whole dedicated module on options, how you can generate the recurring monthly cash flow. We have weekly live classes for guided implementation, cross-checking that, make sure you are doing it correctly, lifetime access for a private Facebook group, and we have Investor Circle Mastermind. So there's a lot of support after you've completed the 6 weeks if you need it. Most people don't need the support. It's all there for you, and it's all for you to take on even after you've finished it, but the support is there afterwards. So I can guarantee you, this is a 6-week program, and guarantee you that in that 6 weeks, you'll get 100 times the value that you might have got today. If you've got light bulb moments today, there'll be 100 times that many. You'll have so many different ways of extracting income, to extract growth, to make the most of your tax breaks, to learn how to save your fees. And you've seen the numbers. We're talking about hundreds of thousands of pounds over a 10, 20-year period. So you'll implement everything in a clear step-by-step way with me looking over your shoulder, as I mentioned. Lots of amazing ROI for you. You come along the Trustpilot website. We start the next program on the 15th of Jan. There's been amazing transformations. Have a look on Trustpilot. I've only just started collecting reviews from people. Everyone's 5 stars so far. Maybe I should ask for 1 or 2 4 stars just to break it up a little bit. People are very happy with their experience. It's been transformative for people in terms of completely changing their investment strategy and saving a huge amount of fees and generating great returns in terms of growth and options income. Lots of positive feedback on Trustpilot. Is anyone interested in options? Is anyone familiar with options? It's a really interesting strategy, and it's one that is gaining in popularity I've been talking about options a lot. So let me explain how options work. Options are very similar to rental properties. It's like having a rental property and earning income off the asset that you already own. So very strong similarities to rental property. Think about when you buy a share. Let's say you buy a share for £100. It doesn't matter what that share is. It could be a blue chip company or an ETF, and you bought it for £100. You can actually rent out those shares and you'll get rental income for it. So you own the shares and you rent out those shares. Typically, this is a conservative example. I'm 1%, 1.5%. You're getting £1.50 per month. This is your monthly rental income on your shares. So how do you do that? You sell a call option. Options come in 2 different versions. One's a put option, one's a call option. So we're talking about a call option here when we're renting out our shares. Your call option is earning you 1.5%. So think of it like a rent-to-own agreement. Is anyone here familiar with a rent-to-own agreement? Like a purchase lease option, right? So 1 or 2 of you experienced in property will know what that means. So call option works in the same way. You have a tenant who is buying the call option from you, and it pays you 1.5%. It's like a rent-own agreement. And in that agreement, you have a strike price of £105 in this example, right? So you have a strike price that's above your purchase price. Okay. And that's what earns you the income because you've sold this call option or this rent-own agreement to your tenant. Okay. So you're getting 1.5%. Now, shares go up and down, right? So your share, let's say it doesn't get to your £105, which is your strike price. Let's say it stays below £105. What happens then? Nothing, right? You keep your shares because it hasn't got to your 105 level. So your tenant buyer will not purchase these shares from you because your agreement is that if it gets above 105, you'll sell it. If it doesn't, they're not interested because they're not going to buy something at 105 when they can already buy it in the market for 101 or 102. Okay. So if it doesn't get to 105, nothing happens. You end up keeping your shares. Your call option expires because it's a 1 month call option. You keep that 1.5% because you earn that already. And then you go again. You sell another call option 1 month later. If at the end of that month, if the shares go up in value to £105, what happens then? Well, you still keep your 1.5% because that's yours to keep. Now you lose your shares because your tenant buyer, let's say it's gone up to £106. Your tenant buyer has now got an agreement to buy these off you for 105 because you buy it for 105 and the market value is 106. So you might as well, as a tenant buyer, you get that £5 capital gain because remember you bought it for 100 and you are selling it for 105. So you get that capital gain and you get to keep your 1.5%. But note here, whatever happens to the share price, whether it's up or down, you keep your 1.5%, whatever happens, right? You see that? You get to keep it because you've sold that call option on day one and you've earned that 1.5%. And if you have to rent again at the end of that 1 month period, you do the same thing again. It's a rent agreement where you're renting out your shares for monthly income and with the prospect of losing it to your tenant buyer. So that's how call options work. If the share price goes up to 105, you've lost your shares. You keep your 1.5%, but you lost the shares. But now, in order to keep earning that income, what do you need to do? You need to buy another asset because now you've got some money in your hands. You can go out and buy another asset. So how do you do that? Just go out and buy some more shares, or there's a smarter way, okay? You sell put options to acquire assets. Now, has anyone heard of underwriting in an auction? Some of you might have done. So when you go to an auction, you can actually underwrite a property. So you can say to the seller, look, if this doesn't sell for your guided price, I'll buy it below guided price. I'll be there. So you've got a guaranteed sale. And if it doesn't work out, if the property ends up going for a higher price, you won't get to buy it, but you'll earn a premium for doing that, for doing the underwriting. You acquire assets through put options. So you've sold your £100 shares, now sell the put option. Remember, it was 105. Let's say you think it's done a little bit too much. I'd rather be buying at 102. So that's where you put your strike price. You get your underwriting fee. In this case, £1.40, 1.4%. So what happens next? These are 1 month options. So in 1 month, if the price is below £102, you get assigned. You get to buy those shares for 102. And you still keep your 1.4% no matter what. If the price had gone up above 102, well, you don't get to buy it because it's sold in an auction to somebody else. There's no assignment, but you keep your 1% anyway. That's yours to keep, whatever happens. Okay, you've earned that on day one. So what happens? You go again. You do the same process again. So you see the theme. In both of these examples, you keep the 1.4, 1.5%, whatever happens. After 1 month, you go again. I've used fairly conservative examples. The range is 1 to 3%, but I'm using more conservative examples here. So you've got call options and then you've got put options. You put it all together and it becomes our strategy. It's the options wheel strategy where you combine the two together. So step 1, you acquired that blue chip stock or ETF. Step 2, you sold calls. We call them covered calls. So you received income for that, 1.5%. Step 3, they got called away because they went up in price. Your tenant buyer bought them off you. Okay. Then you got to acquire more assets. So you sell put options. You get paid for that. Your underwriting fee. You then, if the price gets down to your level, you'll get assigned those shares and they're below market value. And then you just rinse and repeat. You keep earning income all the way through this cycle And that's what we are doing. This is a reasonably vanilla strategy. If you're hearing this for the first time, you think, okay, trying to get my head around this. Trust me, once you've done it a few times, it will become second nature. So this is how he's been doing it. He's been applying a bit of leverage. Essentially, his strategy is the options wheel strategy. Okay, so if there's any questions, drop them on the chat box. So essentially, it's in 2 stages, right? Your step 1 is your call options. You're earning income to agree to let go of your shares in the future at a profit. Okay, in the same way that you'd sell to a tenant buyer. Your step 2 is your put options. You're earning income to agree to buy shares you'd be happy to earn. Remember, you have complete control. You're only going to be doing this stuff on shares you're a happy owner of anyway. Okay, so agree to buy shares at a price below current value. Okay, so that's what the wheel strategy is. I'm doing it all the time. My investors are doing it all the time. We're earning amazing premiums from it. This is something Warren Buffett is a huge fan of. This is exactly how he earns his income. He doesn't advertise it very widely, but he's a huge fan of options investing. This is our options wheel strategy. This is what we teach in module 6 of the Investment Academy. Let's put some real examples to it. So Amazon, let's say this is the share price of Amazon. You've done a fair bit. Let's say you want to buy a bit lower over here. You sell your put option over there and 140, let's say, and you earn 1% in 1 month. You can do it on Tesla, and you can even cheaper here. Let's say you do a 12% lower strike price. You earn 1.3%. If you had your strike price closer here, you might be earning 3-4% on Tesla options. So we'll teach you exactly the steps you need. Essentially, this is it. Does anyone want to give me a stock? And we'll do a live demonstration on how this works. Just put it in the chat box and I'm going to see, we can pick one out. Apple, Amazon. There's a few questions on this. I'll answer all of these questions once we've done the live demo. So let's do Apple, Amazon. Paul, you've said Diageo. The only problem in Diageo next is that they're listed in the UK, which is closed right now. The US market is still open. So we'll do Apple and Amazon. Give me a second while I get my platform up and running. Does anyone have any other questions while I'm getting my platform up? Feel free to shout out if you've got any questions. Wait, take yourself off mute and ask away.
Yeah, hi there, Manish. Sorry, I'll just get off. I'll just put my video on. What? How do you determine the strike price?
Great question. So how do you determine the strike price? So there is a concept called delta. Okay. So delta gives you the sort of probabilities, which I'll demonstrate in a minute. But we use delta. It's the center point of our strike selection process. So on a call option, remember we bought those shares at 100. So on a call option, it's fairly easy because you choose a strike price, which is 100 or above. That's the price you're going to sell your shares. So you make sure it's above 100. On your put option, you use a concept called delta. Okay. So let me demonstrate that to you. You want to make sure it's all probability driven. So you want to make sure that your strike price is sufficiently below your existing price to make sure that you ideally don't want to be assigned. So you place it at a probability of a 70% probability you will not be assigned. Okay. And we use delta to determine that. It's on the platform now. So I'll show you how that works. So does that answer your question for now?
Yeah. Great.
Okay. So let me do Amazon. Okay. So let me just share my screen. We use a platform called Interactive Brokers. This is my paper trading platform. You can do paper trading. So it's simulated, but exactly in the same way you'd find it. Okay, so I would get you to do paper trading to start off with, just to practice, and then you can go from there. So you just put in Amazon here, AMZN, and it's the NASDAQ listing. So you bring it up there, and this shows you the chart, what it's been doing. So you click on options over here. Before we get into options, we need to buy this thing, right? So let's buy this so we can see exactly how it works. So I'll show you the steps, how it works. So go back to quote. Okay, let's just buy, and options come in batches of 100. So we're going to buy 100 shares of Amazon. This is my paper trading account, I think. So I'm going to buy 100 shares. Your order's been filled. Okay, so let's go to our portfolio. And you see you've got Amazon, 100 shares. Perfect. 154, let's just call it. Okay, so now we go into Amazon shares. We go to the options. And this is your options chain. This is where all your options prices live. the first thing you do is you go to the duration of your options. See, there's lots of different options available. There's one that's expiring in 2 days, 9 days, 16 days. I like to do 1 month options. So this is a 30-day option, 1 month out. I bought at 154. So I'm going to rent this out. Where do I place my strike price? There is a concept called delta here, which we take into account. So if we're selling put options, we'd look at deltas of 30, 40, 20 to 40, but we're looking at a call option. I'm going to sell a call option at above 154. Let's sell a call option at 156. So there isn't a 156, there's a 155 and there's a 157.5. So let's sell it at 157.5. You've got two prices, a bid and an ask price. Bid price is to sell an option and ask price is to buy. You always sell at the bid price. When it comes to the options module, I'll give you exactly this process. You don't have to think about this in a huge amount of detail. All the steps are clearly laid out for you. So we're going to sell a call option at 495 like this, and you do a market price at 495. You can see it's 495, 505. So we'll try and get in the middle, $5 per option. What does that equate to in percentage terms? So it equates to, so we're going to get $5 per option, and you divide that by the market price, which is 154. So if anyone's got a quick calculator to work that out, let's just call it 495. 495 divided by 152. This is your monthly income in percentage terms. No.
Well, 3.2.
3.2.
Well, 3.3 rounded up.
So we're getting 3.3% to sell Amazon shares to rent them out in 1 month. You sell your call option at the 157 strike price. Your order's been filled. You've earned your 3%. Resold at 495. So we've made $495. That's yours to keep. Whatever happens on day one now, that's hit my account, $495. So now if I go to my portfolio tab, I've got my Amazon shares, 100 of those, and I've sold a call option. I've earned $495 less commission. For doing that, you can see here is the expiry date of February the 9th. It may not be simple right now because it's the first time you might be seeing this. I can guarantee you after you've done this a few times, it will become second nature. Does anyone have any questions on what we've just done there right now? What if you get assigned shares and the price falls? Yes, you can get assigned. You might get, okay, in this example, it's different, but Amazon shares can still go down. Absolutely. They go down, but it's a share that you like. It's a share that you're a happy holder of. So it might go down, but you're investing anyway, right? We're on this workshop to be investing. So one of the things that could happen to share price, they go down, but we know that they go down temporarily and then go up again, right? So that's fine. You're earning income anyway, whilst you wait for your shares to recover. What I generally say to people is when you're first starting off, do ETFs rather than shares. ETFs give you a more diversified way in. You can do this on the S&P 500 index. You can do on sector ETFs, etc. Nisha was saying NVIDIA. Yeah, we can do this on NVIDIA as well. Evelyn, do you teach in academy? I can replace? Yes, we do. There are EU listed ETFs listed in Germany or France. Evelyn, you're saying you can't invest in US ETFs. Even we can't as UK citizens, yes. But we can through options and through the Interactive Brokers platform. I'll show you ways in which you can get around that rule. Yeah. Ruth is asking, why would people rent shares off you when they could buy their own? Good question. So let's imagine we've just sold Amazon options here, right? We've sold an Amazon option here. What did we sell at? We sold at $500. Okay. Now that person has now got control of Amazon, not for $157, which they would have had to buy for. They've now got control of Amazon for $5. So instead of buying the shares for full price, they've now got control, i.e. if it goes up a lot, they'll be able to control those shares for just $5. That's the power of options. If you're on the other side, you're controlling something at a fraction of the cost. That's why they would buy the shares from you, because it's like a rent to own agreement, isn't it? They don't have to buy the property now, but in 3 or 5 years' time, they have the option of buying the property for exactly the same reason, because they don't have to pay the full amount now. They'll pay it if the price goes up. Why would a tenant buyer do that? Why would they do that when they can buy their own property? Same answer applies. So hopefully that answers your question, Ritz. And if it doesn't, please do come back. What is the benefit of choosing 30-day options over shorter or longer time periods? There are people who do shorter dated options. There are people who do longer dated options. 30 days is the sweet spot because it gives me monthly income. And there are technical reasons why 30 days work better than 60 days. They give you more income on a monthly basis compared to longer dated options. If you do short dated options, you can do weekly options. This involves a bit more screen watching. So a bit of monitoring and management on a more frequent basis. So that's why 30 days for me is the sweet spot. Who rents or pays rent for these call options? It's the buyer of the call option. The buyer of the call option buys it because they can get control over these shares in a cheaper way than they can by buying the shares. Okay, we've covered that already. Someone's asking the course fee, can it be paid over a payment plan? Yes, there is an option. If you go to the checkout page, you can do it in 3 installments. So it's have a look at that. Otherwise, if you contact me, we can arrange some sort of weekly payment plan. If that's something that you are interested in, let me know. Someone's asked a question. We can see the change 1.8%, 1.89%. Oh, so Amazon's up. Yeah, look, shares go up and down on a daily basis, right? So that's what happens. And that's why we earn our option premium, because we are earning that option premium for the uncertainty that goes up and down. So who gets the dividends? We're using the concepts of delta to make sure when we're selling put options, and the probability is it doesn't reach our strike price. We'll keep going and keep on rinsing and repeating around the wheel. Okay. Who gets the dividend during the time option? If you're doing a call option, Evelyn, you get the dividends because you own these 100 shares, you get the dividends. When you're doing it through the put option method, you don't get the dividends until you have acquired those shares. I'm going to just share my last couple of slides. You can just finishing off on the options. Okay. The 1 to 3% is the standard on an unlevered basis. You can get much better than this. Follow the key rules. You'll never make a permanent loss. And that's another guarantee I will make for you. If you follow the process and the key rules, no one's ever made a permanent loss. Okay. So there's a whole load of risk management rules here. There's a free report that some of you might have seen already. So have a look at that. You can actually apply margin. You can lever this. I wouldn't suggest you do apply margin on day one, but once you're comfortable, you can actually get a margin account. Think other people's money. Instead of, if you put £10,000 into your platform, the platform will lend you, give you access to another £30,000 worth. So instead of playing with 10,000, you'll have up to 40,000 to be deploying in options. Again, this is an advanced strategy. So this is something that you can learn going forward. We talked about the wheel strategy. There are things that will give you double the income. There are strategies, for example, the strangle. It's a bit more advanced strategy, but it gives you twice the level of premiums. You can play around with your options premiums to extract even more income than what we've talked about already. Options are very flexible. You lots of ways to extract more income that we've talked about already. Okay. So that's options. I think before we go on to answer your questions, keep them coming. Essentially, if you've got the wrong setup, you will see that return gap. If you've got the right setup, we're talking hundreds of thousands of pounds without a huge amount of money being invested. So just think about that. Be set up correctly. You'll learn exactly how to set up within 6 weeks. All the ETFs and funds and the best platforms for you will be given to you, and your options income strategy, all the steps. And I'll be making sure you are doing it properly within that 6-week period. And don't ever forget this. Our friend Dave Ramsey, money really does move from those who do not manage it to those who do. And that applies to everything you do within investing. Fee savings, making sure you're set up properly,